Well, it's great to be here. And Barbara, thank you for inviting me. Thank you for the kind invitation and the introduction. And I'm looking forward to having a conversation with Mark. So let me just start with the recent data. They suggest that the US recovery is solid and inflation is down. Unemployment has been fluctuating in a narrow band below 4% for 17 months in a row, which is the longest stretch in about 50 years. The share of working age Americans who are employed has risen to highs not seen in 20 years, as you recall, after touching lows not seen in about 45 years. And real earnings are now higher than they were before the pandemic. In a very important development, the labor market is now in much better balance than it was even 6 months ago. American workers have defied predictions that many would not return to the labor force following the pandemic. Recent months have seen the labor force participation rate by prime age workers rise above pre-pandemic levels, and even the participation rate for the overall workforce is now above its pre-pandemic trend. This has occurred as vacancies and payrolls have moderated. The economy is defying predictions that inflation wouldn't fall absent significant job destruction. Just today, we saw new and encouraging evidence that the economy is on the path to moderate inflation accompanied by a resilient jobs market. Annual CPI inflation is 3%, which is very close to the 2.9% average level that prevailed in the nearly 2 decades leading up to the financial crisis. Inflation is now the lowest among G7 nations in the US for both headline and core, even as the recovery has been the strongest. While declines in energy and food prices have been important in bringing overall inflation back down, core inflation is also declining, and it's projected to decline further as rents decelerate. The closely watched category of non-housing core services has been running over the past 6 months at about 3.3%. That's actually close to the 3.2% annual average level that prevailed in the 3 decades prior to the pandemic, and of course, excluding the financial crisis. It'll be important for corporations to continue to bring their markups down after having raised them to unusually elevated levels over the past 2 years, which would help in reducing inflation. The markups associated with price spirals, when final goods prices go up more than input prices, should unwind if consumers are more price sensitive and firms have to compete more intensely. Those economic gains haven't happened by chance, and they won't be sustained absent a deliberate strategy. President Biden's strategy is aiming to grow the economy from the middle out and the bottom up, which is a fundamental shift from a top-down economic approach that too often drove economic policy making in the past. In that kind of an approach, it emphasized cutting taxes at the top and held that government should mostly get out of the way. But the benefits from these policies weren't broadly shared. We did see tax cuts adding trillions to the national debt, but we didn't see gains in real wages or investment. We saw inequality increasing, and many communities suffered from sustained disinvestment, as did investments in infrastructure. Those policies left America vulnerable to a series of challenges that I'll touch on just briefly before turning to current policy. First, of course, China's state-led approach to its integration into the global system resulted in profound dislocations in patterns of production and manufacturing workforces around the world. America remains among the most open economies in the world, and we are strong supporters of the global arrangements that America has led. But we also now know that for growth to be broad and sustained, it's vital to make public investments in our own economic future to safeguard strong pathways to the middle class in communities around the country and to ensure our supply chains are resilient. Similarly, the global financial crisis took a severe economic toll on the livelihoods and wealth of middle-class Americans, And we saw that there is actually great risk associated with trickle-down's preference for deregulation and indifference to concentrations of market power. More recently, the waves of the global pandemic and Russia's war on Ukraine revealed surprising fragilities on the supply side of our economy that contributed to shortages and a surge in inflation. That experience highlights the importance of investing in the supply side of our economy to make it more resilient. Of course, we face additional challenges ahead, including those associated with climate change. We can either adopt smart policy to build the clean energy economy so that it benefits American workers and communities and the overall economy, or face the transition and physical risks associated with climate change that are now apparent in every state in the nation. We have secured historic legislation to prepare the nation to better adapt to change. President Biden's agenda has 3 pillars, and I'll just briefly mention each of them. First, we're making smart public investments in order to catalyze private investment in infrastructure, semiconductors, and clean energy. We've seen over $500 billion in private investment in these industries, and real manufacturing construction spending has increased by nearly 100% since the end of 2021. Mainstream economics has long recognized there is a role for public investment to complement private investment in targeted areas where private returns may not reflect the overall public benefit. Public investment in infrastructure as a share of the economy had fallen by more than 40% over the previous decades. And this was a concern that was broadly shared on a bipartisan basis. To turn this around, the bipartisan infrastructure law is leading to investments in tens of thousands of projects around the country to repair and rebuild roads and bridges, airports, rails, and ports. And in the same spirit as FDR's rural electrification plan, President Biden's broadband initiative is a generational investment that will connect every household and small business in America to high-speed internet. Semiconductors are essential intermediates, but the share of global semiconductors produced by the United States has fallen by 2/3 since the 1990s, in part due to large-scale investments by foreign governments. We saw the effects of that when shutdowns of fabs far from our shores disrupted supply chains and led to really sharp shortages in a whole range of goods in the U.S. economy. With the help of the CHIPS and Science Act, we're seeing private investment in semiconductor manufacturing and R&D with the potential to achieve important synergies with America's robust semiconductor user base and design ecosystem. And of course, smart public investments are also critical to encourage the private sector to invest in the clean energy transition, which is why the Inflation Reduction Act provides tax incentives for clean energy technologies and investments. We're doing this in partnership with our friends and allies around the world, working together to drive down costs and advance the frontier for technologies that are likely to be deployed globally. The second pillar of the President's economic strategy is empowering and educating workers and ensuring a brighter future for communities that have been left behind. Over the last 30 years, we had seen a decline in the convergence of incomes across states and metropolitan areas. Research suggests well-targeted place-based policies that provide incentives for private investments can create good quality jobs, particularly in areas that have underused infrastructure and a skilled workforce. So the Inflation Reduction Act creates and funds incentives, for instance, for private clean energy investment in areas with existing workforces and infrastructure that are well suited to some of the industries of the future. And that includes solar and wind energy projects. And the CHIPS and Science Act similarly is helping to strengthen the capacity of communities with high unemployment to enable them to compete for more investment. A variety of policies investing in education and training, ranging from a commitment to free and universal preschool and free community college to increases in Pell Grants and registered apprenticeships and CTE, career and technical education, are intended to provide more pathways to family-sustaining jobs and good careers, even for those who do not pursue a four-year degree. And the final piece of the agenda, of course, is promoting fair competition and lowering costs. That is why early in this term, the president issued an executive order that made promoting fair competition a whole of government enterprise. That competition agenda is helping to lower costs for middle-class Americans. So, for example, a rule issued by the FDA enabled hearing aids to be available over the counter for the first time, and that lowers the prices of these essential medical devices by $3,000 for the 30 million Americans with hearing loss. Similarly, the out-of-pocket spending cap that's saving seniors hundreds of dollars a year and up to $2,500 a year for some. Similarly, the $35 per month cap on insulin is saving seniors often hundreds of dollars a month. And this simply comes by introducing greater competition. In the weeks and months ahead, we're going to continue working diligently to support growth that is more resilient and broadly shared through smart public investments, educating and empowering workers, and lowering the cost of living. And now I'd be happy to turn to questions. So thank you very much.